And good morning and welcome to another Gemini Academy. This is a forum where we interview various people across the whole of the investment funds industry with a particular emphasis about raising assets. And today is no exception. We're joined by an old friend of mine, Ollie Rolag of Marano Connect, somebody I've known for best part of 13, 14 years now. Good morning, Ollie. How are you?
Good, and you?
I'm very well, very well. As you can see, I'm sitting in Woodland. You're sitting in your London office, or is it your US office?
It's the London office, right on Piccadilly, at the intersection of Bond Street. So
Brilliant.
yes, and we've also moved our offices from New York over to Texas.
Texas. Oh,
Uh,
right. Does
yeah,
that come with a cowboy hat? Do you have
and
to?
and Spurs and cowboy boots, of course.
Excellent. I can't wait for the invite. Ollie, uh, in these conversations, these chats, we try and explore the whole aspect of distribution. And for our view, could you give us an introduction to Marano Connect and what you do and how you differentiate?
Sure, sure. We're probably one of the only players in the industry that actually do what we're doing, and essentially what that is matchmaking. So it's if you think about it, the fund management industry is split up. Is very, very sort of dispersed, with over 100,000 funds available to institutional investors, and we think on the institutional investor side, there's about 40,000 allocators professional allocators that actively allocate to third-party funds. And so what we do is we're a matchmaker between the two sides, essentially. We don't represent managers. We don't say the names of our managers. We don't get paid at the back of commissions. We're just purely an information business.
So you're a dating agency.
Correct. Yep.
Okay.
The
Do
Tinder
I,
of
do I swipe left or right? I don't know. In your
I,
instance,
I don't know anymore.
you couldn't possibly call it. Okay, that's interesting. Can you go into a bit more detail? You say that you don't represent. Just talk me through that process and how that actually works. So I'm a fund manager. I come to you. What actually? Just talk me through that the plan as you see it about rate of helping managers meet investors.
Yeah, sure. So the asset management industry is broken on its head in a lot of different ways. And if you think about how we market to our clients, and we've all been to these meetings. We have a meeting in Chicago or Geneva or whatever, and it's pretty much always the same. It's tell me a little bit more about what you're investing in, and just let the allocator speak for 5 minutes, and then what typically happens is that fund managers will just launch into a pitch. Um, and the that isn't sort of like the way a lot of B2B works in other industries. And so what Murano is trying to do is it's actually trying to understand the allocator, understand how what's on their mind, what changes that they want to make to their portfolio, and really kind of act a little bit more professionally. And this is where you kind of have to look at the evolution of data in some ways.
Okay.
So on one side you have your Excel spreadsheet that's an old conference list that you need to get through. You don't know anything about them, but you assume that they're professional allocators. Then you have companies like Preqin or PitchBook, or some of the other um, businesses, which are essentially gives you a broad scope of what these allocators are doing or who they are. And then you'll have services like MandateWire, which is we're looking to allocate to X. If you are X and you feel like you might be a good fit for us, please apply. What Murano does is not only are they looking at, say, private debt or equity long short or whatever, but we ask questions that are open-ended and neutral, but specific to the manager. So when the allocator or when an allocator says, "Wait, I can't invest in this fund because of X," that's what we need to know. And we need to ask this question in a very neutral, open-ended way, to where there's we kind of go through all the deal breakers.
Okay.
And so if there's a fit, what we'll do is we'll write the report and send it to the manager. If the manager agrees that it is that it might be interesting to speak to that allocator, then they'll reach out referencing the conversation that Mirano had with that allocator.
Okay, so in short, you hopefully get some interest, but you don't then say, oh, by the way, I've got XYZ manager who's going to call you. You just expect the fund manager then to connect with that allocator in due course because you recognize there's a warm lead there.
Yeah, and if you think about it, it's a little bit like I don't want to say the anti third party marketing, but it is sort of like a tool that a lot of third party marketers will offer, which is the client identification piece.
Right.
So we just stop short of when the marketing should happen versus when the information is there.
We just touched on that. Could you explain the difference for our viewer, the difference between yourselves and a third-party marketer? I know you've been quite vocal about third-party marketers, and you and I have had numerous conversations over a beer in the West End over the years about third-party marketing. How do you see Mirano being different from a TPM?
So just to be clear, we have nothing against third-party marketers. We have a lot of third-party marketing friends. But third-party marketing is not always the answer to what a manager is trying to look for. With our service, we have a belief that if a fund manager needs to know how to sell their fund. If a manager can't sell their fund, they can't expect strangers to do it for them, and so we're very much of an in-house solution for the managers. And there are advantages and disadvantages to this. The one thing is that if you look at the cost of asset raising, and you ask yourself, how much does it cost to raise $100 million? And you separate this cost into the steps of the whole process. So on one side, you have client identification, and then you have process.
Yeah.
So so in terms of client identification, that's where you have the third-party marketers. That's where you get the conferences, all the things that managers do in order to meet allocators that might be a fit for their product. That's where the majority of the money is being spent. Right. The disadvantage of third-party marketers is that you're not able necessarily to control the message. The ownership of the sales process eventually has to go in-house anyway. And so our view is that if the fund managers if we can make the client identification process efficient, then Mirano is an incredibly cost-effective way to tackle this issue. And one thing that's interesting is that we know that if our clients or our fund managers are getting high meeting rates, what we tend to find is that they also have a very good process behind it.
Okay, because they're not just warm leads. Then they're pretty well hot leads in that instance, aren't they?
Well, I wouldn't say leads is one of the words that we banned from our sales team.
Oh,
because
I'll never get a job at Mirano. Okay,
no, because for me, a lead is a business card. And in the industry, this is really, not only do we know that they're looking for at my fund, but my fund should be a good fit. And we have enough information about the allocator that that it would compel us to have a meeting. The other thing that Mirano is kind of helpful with is that if you look at it from even a somewhat of a compliance perspective, you need to know who that client is or who that allocator is. And what we found in over the past 12, 13 years is that our services gravitated more towards the sort of like very large asset managers and banks and insurance companies and so on, because with our information, they know that they're speaking to the right allocator at the right time with the right strategy, and and they don't have to worry about, okay, well, is this person even interested in what I do?
Gotcha.
So to speak.
Thank you.
So
let's move on to something else, which is a much quoted line from a rather famous film with Kevin Costner, The Fields of Dreams, when they talk about, if you build it, they will come. And we see a lot of fund managers building things, and they sit there and they wait for the monies to roll in, and they don't understand it. And yeah, someone with a background in distribution like yourself, Ollie, we sit there and go, well, you've got to go there and promote it. I mean, what do you believe is a key to successful fundraising from where you sit?
We've had a lot of conversations about this, haven't we?
Is there a secret sauce? I mean, I don't know if there is.
Yeah.
I don't know.
I mean, it's funny. Again, you know, the asset management industry tends to be upside down, to where you know, we tend to look at ourselves as specialists in a certain area. So, for example, I am the best in trading equity volatility, sort of thing, and so since I'm the best, people are going to allocate to me. I think the problem lies in that we are very myopic in our sort of focus, where we're so product focused that we don't really take a look at the broader aspects of the business. You know, why would anybody buy my fund, and who else out there is you know, am I competing with?
Yeah.
So it's almost like, you know, if we're going to use this analogy fairly often, is that, you know, if you and I were going to set up a coffee shop downstairs, we wouldn't just say, I like coffee, let's set up a coffee shop. We'd be looking at a whole bunch of different things. We'd be looking at foot traffic, ways to get to it, what are the demographics, you know, competitors, all these other sort of things. And so we see this very often in asset management, particularly when you have somebody or a manager who's trying to go international, and they'll just set up a fund and hope that it'll be distributed, and not really understanding the mechanics behind it, or the competitors. And so you think about it, I mean, you know, how much money does it cost to, you know, before you understand you made a mistake?
Yeah. We see it a lot where managers can burn through a lot of money without actually stepping outside of the door and going out and meet investors. So it becomes a key challenge. I fully understand that, but it's not something this seems to have changed over time. You know, we've been doing this a long time, and I don't see that fundamentally shift from fund managers recognizing the value of distribution engagement, whatever it may be. I mean, here's another one to throw at you, which is really about the geography and the key targets and key players. When you're working with managers, do you sit down with them, say, who's your target audience? Where's your target geography? Or is it a bit of both?
It ends up being a bit of both, but we do ask that question. Oftentimes what will happen is, or actually maybe I should just roll through the numbers a little bit about, you know, the amount of data that we have. We have roughly 120 managers on the that use the service. They range anywhere from, say, you know, a tiny reputable startup all the way up to the largest asset managers in the business. Over 3/4 of our business are with managers that are over $1 billion in AUM. We are roughly 40 people at the firm. 27 today are on the phone talking to allocators all over the world. Each one of those analysts will probably write one report a day on average. So we have a lot of information. And then in our CRM, we currently have 65,000 records, so individuals. Which is not correct. It's probably, once that gets cleaned, it'll probably be 45,000, 40,000 allocators. But we've spoken to roughly 23,000 of those allocators over the past 12, 13 years. And we have regular relationships with about 10,000 of those. So where we call them every 3 to 6 months. So to answer that question, what generally happens is that we have this very, very large repository of information of people. And oftentimes the manager will come in and say, okay, well, we think this product is going to be good for X, or it's too sophisticated, so we only want people who can allocate $25 million or more to the strategy. And what happens is that the data shifts the strategy, the sales strategy, because it's interesting, because, you know, the manager will come in and say, this is a useless product and we can only market to, say, Switzerland and the UK. And then we say, well, why don't we just open it up to Europe for the next month or two, see what's going on. And then they start to find markets in Germany or France and where they'll have to start registering because there is a requirement for their product in that country and not so much in these other countries.
Right. Actually,
So
you just touched on something there, Ollie. I guess because you're doing the marketing, and I use that word very, very carefully in this context, but you're engaging with allocators, you're not promoting the fund. So your example there of Germany, the fund manager doesn't need to be registered in Germany for you to go and speak to asset allocators because you're not talking about that particular strategy. So if there's someone who then says, yeah, well, we want to allocate, at that point, would that be seen as a reverse inquiry, reverse solicitation, do you think?
No, I don't think so. Yeah, you're right. You have to use marketing very carefully because we do not market.
I appreciate that.
But since we're not representing any managers, we don't say the names of any managers. We're purely information seeking, and so every so each if you're sort of like a very common fund, you're not very niche, or you're niche but you're not that niche, then let's say you receive about 2 to 4 reports a week. Over time, that information builds into a data set to where we have a very natural filter in terms of investor type and location.
Yeah.
And so what happens is that not only are from a micro level are you saying, okay, well, we spoke to this German pension fund, go see if it's relevant, but then we also get a macro picture of what a natural sort of filter, not unbiased sort of information that kind of flows into the data set pretty much.
Okay.
And so we get good demographics of where each one of these managers kind of fit. So if we send a report to a manager that's not registered in Germany, then it's up to them to decide whether they want to market or expose themselves or not. Typically, what will happen is that the managers will just collect that information and then do some fact finding as to whether that country's of interest or not. But we are not involved with the compliance because we are only information. It's up to the manager to determine whether they want to get exposure to that country, to register into that country, all that sort of stuff. So again, it's like a tree falls in the woods. Does anybody hear
it? Yeah, exactly.
So essentially, if we send a report to a manager, and the manager doesn't act on it, but as information fact finding, there's no harm, no foul. They're not falling foul of any compliance issues.
Okay. Let me just touch on something there, and it's an area that we have discussed before in previous conversations. Ollie, I come from a wholesale distribution background. That's my beef. Obviously, you have institutional salespeople and sales marketing. There's a lot of blurring around the edges there. Do you see that in as far as your targets? Do you see any blurring across the channels historically? I know you're not a specific channel expert, but I'd be interested to know from the experience and the exposure you have to asset allocators whether or not there's similarities between the pension fund, the German pension fund there, and a wealth manager sitting 100 yards from your office. Do you see much similarities?
Yes. Yes and no, I think, is because I think when you're talking about channel sales, especially when it comes to white labeling and things of that nature, we speak to those businesses or those channels also. But I think if you look at the majority of the industry that we speak to in terms of quantity, it's wealth managers, pension funds, endowments, all these other sort of things. So in terms of quantity, the channels are relatively few, but they're very large. But again, that kind of goes into when you're looking at sort of placing product. The product oftentimes is not the appetite for this product in certain channels is not as high because the fees are probably too high for a lot of wealth managers.
Yeah.
All these other things, to where these products are geared more towards specialist allocators, I
Okay.
think.
Right. When it comes to launching a fund, a new fund, what advice would you give to a manager when it comes to actually not just actually creating the strategy? Because what we tend to find is they have already established strategy and they want to create it into a UCITS or an AIF for the global market. I'm talking obviously here from a US manager point of view, but also could apply to an Asian manager. But what advice would you give to an asset manager who wants to take their product, their structure, their strategy into the broader market?
Don't do anything.
Don't do anything.
No, I mean,
Excellent.
I
I don't
think
think I'll take that one on board, I'm afraid, Ollie.
no. What I mean is, I mean by that is listen to the market. I don't know about you, but I can't tell you how many times we've seen products that were, especially UCITS back in the early 2010s. I don't know if you remember, all the hedge fund managers were going into these UCITS funds,
Yeah.
and they weren't listening to them, and so they would come in and say, well, actually, I don't like bi-monthly redemptions because for whatever reason I need daily, or the fees would be too high, or all these sort of things, to where oh, we don't like this structure, we want this structure. I mean, how many times have we seen that?
Yeah.
And so really go to the market that you want to market to, talk to the people that you think your product should be positioned, and then listen to them.
I couldn't agree more. It's the biggest bugbear that I have is when managers come to you with a fait accompli product and they don't understand when you say, well, you got the price wrong, you've got the pitch wrong, you've got the geography wrong, you've got literally the list is endless, and they go, well, what do we do about it now? It's too late. You've got to have to redo your supplement, you've got to redo all your documentation, your marketing documentation. So it's a frustration. You're absolutely right. Go talk to the market, find that, and go to someone like Marano and find out what's going on. I mean,
Yeah.
as a consequence of that, where do you see when it comes to assets and strategies? Where do you see the biggest growth? If you had a crystal ball, where do you see that biggest growth for the next 3 years or so?
Well, it's interesting because what's interesting about this business is that the Murano evolves with the industry changes.
Mm-hmm.
And so when we started, we were doing a lot of trend followers and macro funds and everything, and it was just after the GFC, to where there was kind of a look back and said, oh well, the macro guys and the CTA guys or girls or whatever did really well. So that's where the interest lies, and the portfolio, the Murano portfolio, is kind of tilted from hedge into private equity, into private debt, and then back into hedge for now.
Okay, so
And along with all the plain vanilla products, the
yeah.
equities and the bond portfolios and all that. I think what the industry or the managers don't really understand is that if I'm an allocator, my views are my portfolio is going to look very, very similar to the manager's portfolio. And in other words, what I'm trying to do is I'm trying to diversify. So let me back up. I have two big issues. I have a return target, and I have maturity for my portfolio. And so my job as a third-party fund allocator is to build a portfolio that will match that return target and be robust. And so whenever I go look at managers, there are a lot of things I'm trying to solve for, but the biggest issue is that I'm trying to optimize my risk per unit of return. And so what I'm essentially doing is I'm buying decorrelation in the portfolio. And so it's not that I'm just looking at stocks or bonds or hedge funds or private equity or private debt. I'm looking at everything across the board in order to build a robust portfolio that will do what I'm mandated to do.
Yeah.
So I just don't, event driven isn't the flavor of the month, or private debt isn't the flavor. All those have a fit within my portfolio. Whatever my mandate should be.
Yeah, no, I agree with that, and it's one of those things we've seen in recent times. In very recent months, I've been to a number of talks where people talk about private markets and private debt, and I'm going, fine, that's great, but you need to structure them away in that people understand it. Not just the allocator, but also the end user, because particularly if there's a see-through to Mr. and Mrs. Smith, you've got to be able to articulate that and particularly de-risk the portfolio so people understand what they're buying. That's key. Otherwise, we might have some massive mis-selling scandal in 5 years' time if we're not careful. And also the structures that they come in, because AIFs are a particularly professional investors only, 100,000 euros, whatever it may be. Yeah, so they become quite complicated for some investors. That is true. That leads nicely into the biggest mistakes when it comes to launching funds. What do you see that you see managers make when it comes to launching or attracting assets? Where do you see? And we touched on pricing and getting the proposition wrong. What other areas do you feel that they make the mistakes around that?
Well, let's see. Aside from not really understanding the market, and just blindly launching something that isn't fit for purpose, would be also the lack of flexibility.
Right.
I would say.
What do you mean by flexibility on that in that instance?
Well, take for example, a lot of the U.S. managers or hedge funds that have monthly liquidity and can go into the UCITS fund and say, okay, well, we're going to be offering bi-monthly liquidity. And first of all, if it's like an equity long short fund, the liquidity is there for daily. It should be there for daily, right?
Yeah.
And the problem that you have when you have bi-monthly, the reason why people will knock it off the table is because if I'm rebalancing my portfolio in a fund I'm at a private bank, I have a fund of funds, I'm rebalancing my portfolio. I have all these changes that I need to make, and then I have this one fund that's bi-monthly, and if I rebalance and don't take that into account, I have a lot more chance of making an error.
Yeah.
So the daily what's interesting is like daily liquidity is actually great, and it provides a lot more comfort to the allocator. Because the more liquidity or the less liquidity you offer, the more volatile your AUM stream can be. Because as an allocator, if I think your liquidity is going to be bi-monthly or monthly, quarterly, whatever one it doesn't need to be, then I'm going to redeem a lot quicker from that manager, as opposed to the manager that I know I can get my money back in 3 days.
Yeah. Okay.
So there's a misunderstanding of the market. And I think there's a little bit less of an appreciation of the business side.
Yeah.
To where the asset management firms are typically owned by the fund manager themselves, on the boutique side, and that means they have a very, very big product focus. But the biggest thing that matters is the denominator, the AUM.
Yeah.
That's the business. And so, taking off your specialist investor hat and putting on your business hat is actually quite rare to find in the industry.
Tough one. Yeah, it's a tough one. Yeah, we find that with a lot of the managers we work with, where the owner is the fund manager, and they're two separate roles and responsibilities often.
Yeah.
So.
And then also, Stuart, actually, if I can add to that, is that the person who actually is supposed to be running the business is typically doesn't have a track record in running businesses.
We say this: fund managers should stick to what they're good at. Stick to fund management. Stick to actually running the money, and allow somebody else to go and do the other stuff: running the business, running the administration, running distribution. Whatever it may be, that's really important. Ollie, just in those concluding moments, I say you and I have known each other for a long, long time, and I'd love to know, if you weren't doing what you do today, what would it have been? What would you like if you didn't do this? What would you want to do? What would you be?
I ask myself this every day, funny enough, and it changes all the time.
Really?
working at like a local council, working in government on a very local level. Sounds like it could be fun trying to help people.
Okay, that's like 180 degrees from what I thought you might say.
What do you think I was going to say? Florist?
No, I thought you might say something like hunting, shooting, fishing sort of guy on a gate on an estate somewhere. I know
Oh,
you
that'd be
like
fun.
hunting.
Yep, yeah, no, it's lots of fun. But no, it's I think the it really is trying to help people in some sort of on a community level. Um, it, I think that if you ask me, I don't want to leave this industry ever. And if I do, it's going to be feet first.
Yeah,
Um, I love this industry because you speak to some of the smartest people on the planet. The asset management industry is a wonderful place to where people are trying to solve problems,
yeah,
invest in like green technologies or help businesses thrive. All this other sort of stuff. It, for the 95 or 98% of our business, it's really people trying to do the right things.
yeah. I agree. I totally agree. I used to have an old boss, Charlie Brady, at Investcap, and who I think passed away a few years ago. But he actually said to me once, "We should be proud of what we do in our industry because we're here to make people richer." Now, in some cases, that's the fund managers, but 99% of the time, it is investors, and that's what we should do. Ollie, thank you. I'm going to excuse the pun, but I'm going to say thank you for joining the docs, noting to the docs behind you. It's been great to catch up with you. Thank you so much for sharing your thoughts with us today. And we look forward to speaking to you soon. Thanks very much.
That's good. Thanks, Stuart. Thanks so much. I'll speak to you soon.